Well, so far it's been a stormy winter for the financial markets. So is springtime near, or is an even bigger storm brewing? Hi everyone, I'm David Scranton. And if you don't enjoy roller coasters, then you probably did your best to ignore all that happened with the financial markets throughout January. Wall Street's ups and downs were, for many, as hair-raising as they come. Now, the ride did smooth out a bit toward the end of the month, but is the scary part really over? Well, we'll be answering that question and more on today's Market Update show. Specifically, we're going to be covering what's up or what's down with the stock market, what's up or what's down with interest rates, with inflation, what spring might bring, and of course, most importantly, what it all means for members of the income generation. So if you think of the stock market as a roller coaster, the January ride began with all the cars clicking their way up to a new peak. In fact, on January 4th, the S&P 500 actually approached 4,800 points. And a day later, the Dow made it to almost 36,800, both which were new record highs. Of course, the roller coaster is then propelled downward by momentum, and that did kick in toward the middle of January. In fact, by January 21st, the Dow was down by over 2,000 points, and on January 24th, the S&P 500 officially entered correction territory, which means that it was down more than 10% from the peak. So what were the main drivers of all this volatility? Well, there were at least four. One, of course, was inflation. The second was the Federal Reserve, which announced in December that it would start raising short-term interest rates again this year to help deal with inflation. The third issue was long-term interest rates, which rose faster in January than they did at any time since January of 2020. And of course, the fourth issue was corporate earnings. Investors were anxiously awaiting the results of fourth quarter earnings reports in understanding that economic growth had really stalled in the third quarter of 2021. But let's take a minute and take a closer look at two of these issues, inflation and interest rates. The inflation rate reached 7% annualized in December, making it the fastest month-to-month rise in prices since June of, get this, June of 1982. Now, although inflation has caused occasional market volatility over the entire past year, there are at least three reasons that it hasn't caused more, at least so far. One reason that it hasn't caused more volatility is that investors factor inflation into their projections, and most have been expecting this bout to get worse before it gets better. Two, as a result of three massive economic relief bills, as well as the Federal Reserve's quantitative easing efforts, there's still a ton of money flowing through the U.S. economy. And three, both short-term and long-term interest rates are still relatively low. The first creates an incentive for people to borrow money. That's when short-term rates get lowered. The second creates incentive for people to invest in the stock market. That is when long-term rates are lower, because it makes other investment options on the surface appear to be less attractive in comparison. And both outcomes, yes, can help drive economic growth. And that growth did return after faltering last summer. In the fourth quarter, real GDP grew at a seasonally adjusted annualized rate of 6.9%. So when I say real GDP, I mean adjusted for inflation. The recovery was largely a result of holiday spending and the fact that Omicron variant wasn't yet a major concern at the end of last year. But of course, that all changed in January, and so did the concerns about interest rates. Bond yields across the board have risen significantly in the new year, mainly in anticipation of the Fed's plan to raise short-term rates and to reduce their balance sheet by doing essentially reverse quantitative easing, known as quantitative tightening. In fact, at its January meeting, the Fed has said its plans to start raising rates in March, and it may approve up to 3 more rate hikes this year. So what could that mean for the long-term rates and for the stock market? Well, here are 3 important things to know about the Fed's plan. First, raising short-term rates helps lower inflation. How? By decreasing demand for goods and services, because people simply tend to spend less when borrowing costs are higher. Second, decreasing demand also by its very nature slows economic growth. And third, raising short-term rates, unfortunately though, does nothing to address this supply chain problem that you've been hearing about on the news, which essentially is maybe as much as half of today's inflation problem. So what all this means is that timing will be crucial for the Federal Reserve. Despite the economy's rebound in the fourth quarter, investors still seem uncertain about how strong it really will be. If the Fed's initial rate hike in March coincides with a bad first quarter earnings projection or another big jump in inflation, that could send the markets into a tailspin. So what does all this mean for income investors? Well, first remember that long-term interest rates also spiked early last year. It's a well-known fact that rising interest rates create headwinds for income investors. Why? Because when interest rates rise, bond prices tend to fall. But as I always point out, the equation is really not that simple, because interest rates aren't the only things that affect bond values. Another important factor is something we always talk about called credit spread compression, because this helps create, in essence, a natural softener for income investors, because it helps minimize the impact of rising interest rates on bond prices. Last year's first quarter rate spike offered a great example of this. Interest rates came up, but many fixed income investors, if they were in the right things, lost very little, if any, in the first quarter, even though interest rates, for example, on the 10-year government bond almost doubled. So here's the point. Income investors can count on credit spread compression along with other actively managed strategies, if they're working with somebody who actively manages income-based securities, all to work in their favor if interest rates spike into the new year, or continue to spike, I should say, past January. So more importantly, any loss in value, especially in individual bonds and bond-like instruments, you need to remember is only temporary. Why? Because it's truly a paper loss. Because the face value of your investment is guaranteed, assuming there's no bankruptcies or no defaults. And almost more importantly is the fact that the fixed amount of income, the fixed dollar amount of income, is not affected just because the price of the bond or bond-like instrument drops. So what if the Fed does mistime its moves and the stock market, for example, suffers an even bigger correction? Well, if you're an income investor with a higher risk tolerance, that could create a great buying opportunity, an opportunity to become a little bit more aggressive in your portfolio, if you're so inclined, and increase the income and also increase the growth potential of your portfolio through stock dividends and through capital gains. Either way, with so much uncertainty brewing, right now, I believe, is the perfect time to reassess your risk tolerance and to reassess your allocation, preferably with the help of an income specialist. And now it's time to bring in today's guest, of course, Jeff Small, president of Arbor Financial Services, a retirement income store located in Melbourne, Florida. Jeff, as usual, great to have you here to talk about the markets.
It is awesome to be with you guys today, Dave.
And of course, now I'm happy to be able to introduce one of our frequent guests, today's special guest, John Najarian. He's an options trader, and he's co-founder of Market Rebellion. He's also the co-author of the book, Follow the Smart Money. John, once again, our pleasure for having you here with us.
Oh, thank you, David. Jeffrey, always fun to do your program.
John, here we go again. I feel like we keep having the exact same conversation. The market's even become more bipolar. You know, a good portfolio manager only has to be right 60% of the time. But I want to talk about something that's near and dear to your heart. You help investors all across America every day through marketrebellion.com and on CNBC. So tell us what investors should do today going forward in this tightening environment with rising rates and rising inflation, because the dynamic has completely changed.
Yeah, I think you're correct, of course, that dynamic has changed. I would basically zoom out, look at the bigger picture rather than zooming in, because on a day-to-day basis, if you trade like I do, then you have to zoom in. And I wish I could be more like many of your viewers, most of your viewers probably, and take that, again, zoom out picture, because the market is still in that same uptrend, Jeff. It's just we're seeing a lot of back and forth. Is the Fed going to overreach? Are they going to throw a 50 basis point rate increase? Right now, the 10-year bond's saying no, they're not. So I think the 2-year bond, because we always look at the 2-year versus 10-year, and again, that's because we're zoomed in. If you zoom out, what you've really seen is interest rates are really low. Corporate earnings in most cases have been spectacular, and they should more or less not pay attention to the noise of the day-to-day trade every day, Jeff.
Recently, John, you said on CNBC, the Fed has to talk like a hawk. And of course, it worked in most of 2018 when they were trying to raise interest rates until, of course, December when it didn't work anymore. So putting the talk aside, do you think that, do you think they're going to be able to do 3 or 4 interest rate raises this year? I know before you didn't think so. Has your thought changed at all?
No, I am still in that 2 to 3 camp, David and Jeff, and I think they'll be lucky to get those in because we're just in the midst of an ADP report, which was dismal. Certainly the worst of President Biden's tenure and the worst in a very long time. In other words, whether it's Omicron, whether it was vaccine mandates, whatever, we saw private payrolls just dropping like crazy into the negative territory. And so I don't think that you're going to see those 4 and 5 rate increases that people that want to grab headlines say that, but I don't think they believe it either. I think the Fed will be lucky to get away with 2 rate hikes this year. And if inflation stays as high as it is, the inflation that they can control, that is, then I think maybe they throw a 3rd at it, but that's as far as it goes.
Yeah, because half the problem with inflation right now is still the supply chain side. And of course, as you know, the Federal Reserve really doesn't have a tool to fix the supply chain side. They only have a tool to fix the demand side.
Correct. And that supply chain side is still disrupted. It's getting better, but it's still disrupted. And the last thing you really want to do when people are paying higher prices for food, higher prices for gasoline and so forth, is throw an additional speed bump at them with higher interest rates. So I think it'll be a gradual, not a leap higher in interest rates.
John, the Fed is behind the curve. They didn't get ahead of inflation, and now we have excessive inflation, and they're going to try and catch up too quickly. So that's going to affect investor portfolios significantly if they over-tighten. You said in our last segment, though, only 2 to 3 rate movements, maybe. A lot of financial prognosticators on Wall Street are saying 5 to 7. Why the disparity?
I can't explain other than people grabbing headlines, Jeff, because no right-thinking person really believes that the Fed would basically, you would not only turn over the House and the Senate, but you would have sentiment so negative against this administration if you saw 7 rate increases. I mean, again, I don't think the Fed wants to be political. And if they did such a thing, they would basically throw the baby out with the bathwater. We would see the market down 20% plus. We would see a whole bunch. I mean, what happens when you do that? You have firms hunker down. That means they don't hire. It probably means they lay off. It probably means they cut their spending and all the rest. All of those things are negative for consumers, of course. And the 3 of us care a lot about consumers. And what we don't want to see is the Fed overreach like that. So somebody saying that, I can't believe they really believe that in their heart of hearts. You're right. The Fed did wait too long, and they did use that transitory term way too much. But now the damage is done. Inflation's been here for quite a while, and it's just a question of, do they want to make it worse?
Well, it's funny because if you think back to even 2018, they were only able to get federal funds rates up to, I believe, 2.25 before the bond market really jumped in and said, you're not going to do this anymore. And now, of course, we're 5-6 trillion in the hole, further in the hole than we were back then. So can they even get to 2.25, even if they try to, over the course of a few years? I don't know.
Well, and like we said in the first segment, we've seen the 2-year, and traders always look at that relationship, the 2-year to the 10-year. And as that 2-year keeps moving up, and the 10-year is actually down in the last couple of weeks, down, even though we've had all this tough talk. So like I said, the Fed will have to talk like a hawk, but I don't think they'll be able to walk that walk, David.
So what are some of the other factors, and what do you tell average income generation members? We've got this thing right now with Russia. We've always got these COVID variants. We've always got this thing hanging over our head that, God, the market's been going up for so long, it's overdue. When you take all that, you put it in a blender and you push the button, what are the biggest risks and what's the best advice you have for those retired or within 10 years of retirement?
Well, I'd say when you're talking about the first issue there, Russia, all the more reason to be in energy stocks, because if there's a disruption, if there's an incursion by Russia, as the president called it, a minor incursion into Ukraine, prices are going to keep moving higher for energy. So what would I do income generation wise? I'd own Exxon, and I'd own a number of other energy production stocks in America. I know they have exposure elsewhere, but I would focus on America, high dividend yields. And for those of them who actually choose to learn a little about options, they could easily take that into double digits as far as the return on that. Sure. And I think that's going to be very attractive in 2022.
Sure. Great. I love your recommendations. Stick with dividends. That way there, even if you're wrong on the oil side, that's okay, because you're still getting good income. You're still getting a good yield. And of course, as you know, when you get into retirement, it's all about the income. So John, Jeff, once again, it's been my pleasure. Great having both of you back here.
Thank you.
Thanks, Dave.
Thank you for watching today's market update video. If you enjoyed it, click the thumbs up button, give us a like, and make sure that you subscribe to our YouTube channel for new content each and every week.